wise man once told me, good news and good prices, they rarely come together. Right now, there is absolute mayhem in financial markets. Reset button has been pressed. Expectations are being revisited. There is a global growth concern, and emerging market funds are getting billions of dollars of redemptions on a daily basis. So what should be a very basic portfolio approach in this kind of a market? Warren Buffett once said that you should always sell greed and buy fear. Is it a good time to put money to work? And where are some of the key pockets where true value has emerged for our long-term investors? To discuss all that and much more, I have a very special guest with me, Nimesh Shah of ICICI Prudential. Nimesh, fantastic to connect with you, and thank you for joining us on this show. I'll start with a very basic question. Given what is happening to the world, there are fears of deflation and growth has got challenged. Is the bull market intact?
This is a market which last time when I had come to your show, I was talking about volatility, that how volatility will continue and volatility is going to affect. It's better to invest in funds where volatility is high and how they gain out of volatility. But now with what has happened and the markets getting corrected, we sometimes feel that this is the time where one should be. I don't know about bull markets or bear markets, but if you have reasonable expectations out of equity markets over a 3-year period, it is a good time to invest.
Why do you think this is a good time to invest? Because historically we've seen that every time when a global reset button has been pressed, whether it is 2008 or 2011 or 2013, even India could be the best story in the town. We are not immune to global volatility.
That's why I said this is a great time. I will also refer to those 3 years, 2008, 2011 and 2013. We have always seen that whenever the FIIs have sold and Indians have bought, it has always made sense in the post. If you see, it has always made money. Whenever FIIs have sold, and I said with a 3-year paradigm, I didn't say for a short-term paradigm. Today I'm on your channel, I'm very happy to come on the channel 1 week down the line, 15 days down the line, when I'm proved wrong also. But in 15 days time you can go right, but I am asking you to go wrong. But in 3 years paradigm, I believe that earnings will come back. I believe there are a lot of companies where capacity, if you look at whether top down or bottom up, top down, India is a fantastic story. There are very few countries in the world where the macroeconomics looks so strong. There are very few countries in the world where interest rate is expected to come down. There are very few countries in the world where there is a latent demand in the country and where the capacities that have been set in have not been fully utilized. And there are lots of industries in the country which will benefit. India as a country will benefit out of low commodity prices, and there are a lot of industries which will benefit out of low commodity prices. And I think it's a great time to invest in India with a 3-year paradigm. So that's why I agree with you. There are a huge chance of me going wrong in the 15 days and 1 month span. Because there is an emerging market, I understand the risk that we face. Investors should be very clear. There can be a risk of an emerging market sell down, which has got nothing to do with India. When a ETF in the West or an emerging market fund in the West gets redemption, as part of their entire emerging market package, they will have to sell India also. So if that happens more, that is what has been happening in the last 20 days, 1 month. And if that continues, we can have more sell-off also, and markets can correct slightly from here also. So, but still, if you have to invest 100 rupees in the market for the 3-year paradigm, I would suggest that your investors should invest 20 rupees today.
Now, Nimesh, Indian markets were always expensive, and historically India has always traded at a premium to other emerging markets. But have markets corrected enough? When growth expectations have got reset, do you think margin of safety is now apparent?
Yeah, when we look at the tick marks, valuations are reasonable. I'll put one tick mark over there, that valuation with the current year's profits that are expected, you are looking at a PE of around 15. It looks like a very reasonable valuation. When I look at sentiments have started becoming negative, at least outside the country. When you go outside the country, sentiments are negative, flows are negative. So all this environment, when we believe that in any asset class you can make money when, in fact, we get excited when past 1 year return is not there. So for me, all these are green indicators that past year return, sentiments are negative, flows are negative, and we are got reasonable valuation. So even why I would say invest in India, because I believe there are lots of companies, when you do bottom-up research, there are lots of companies where capacity utilization is not to the full, and they will be able to utilize their capacities over the next 3 years. That's why I am saying back-ended. I am more rather than 15, 16. I don't believe, I'm not telling your viewers to invest in the market with a mindset of 15, 16 at all, because nobody knows. At least I don't know which way the markets will go, to what extent emerging market redemptions will come in. That I am not sure. But I am reasonable. We have done reasonable work to understand that there are lots of corporates whose earnings can go up over the next 2 years. So I am banking on earnings going up on 15, 16 and 16, 17, 16, 17 and 17, 18, which is what is our investment thesis, that why you should invest right now.
Nimesh, if I look at the holding patterns, now large part of Indian blue chip stocks are currently owned by foreign institutional investors. And the concern by market watchers is that if foreigners who are considered to be the real owners of Indian equities, if they are selling, can Indian institutions and mutual funds absorb so much of offloading?
That depends on the amount of offloading that happens from the West also. And I have not met anybody who has got any indications of the same. Even if we believe around $2 billion can be sold by foreigners tomorrow, I cannot say that till now the flows have been positive. In fact, whenever markets have fallen, we get our maximum inflows. The inflows into our funds goes up big time the days market falls. So that we are seeing a continuous pattern, that inflows increase in the funds. To what extent will we be able to take it, I am not sure, because if there is a sell-off by foreigners, market will correct to a certain extent. But if one set of foreigners, if the ETFs sell today, I am very sure there are a lot of hedge funds sitting in US. At a certain level, they will be the entrance into the market. I had come on your channel in October 2013 when we had given a big bull call on equity, saying that, thumping the table, we had said that invest in equity. The reason we had done that is we had understood that the valuations are very reasonable, and we had met a lot of hedge funds in US who were saying at that point of time that market falls below 19,000 and we will be the ones to enter the market. We were very clear that they were the vulture funds who wanted to enter the market as soon as India comes near 18,000, they were entering the market. I think at that time the dollar was also touching 66. So their thesis was dollar going beyond 66 and market falling below 19,000, they will enter. So foreigners, if the ETFs or the emerging market funds exit today, and if the local funds are only able to absorb some amount of the sales that they do, and even if the market corrects, I am very sure there are another set of investors who will be opportunistic investors who will be coming on every correction that happens in India. So market has even the foreigners investing in India has a way of correcting out the outflows. So I am again saying I don't know what will be the kind of outflows in the next 6 months, next 1 month. But I am asking people to invest with a 3-year paradigm.
Nimesh, what ultimately drives equity markets are two factors, liquidity and growth. Liquidity could remain uneven given what is happening to emerging market currencies and what is happening to risk. And growth is not there. If I look at the basic core data is not impressive. There are more downgrades than upgrades. So when the environment is not conducive, what makes you bullish even about the long-term picture? Why do you think things will turn around?
It will be a stock pickers market. It will be a selective market. I am not saying widespread. That's why I said bottom-up stock picking is going to become very important now onwards. We have got certain views on some sectors which we believe, and especially some bottom-up companies, where we believe there is a huge play that is possible. And we are firm believers of cycle. Today you are looking at a whole commodity index which is going through a negative cycle. The same will turn around over a period of time. So that are certain reasons. I am only talking about bottom-up research. if private sector banks are a good investment, we believe private sector banks are a good investment. Any industry which is competing with the government sector, we believe that is a thesis for investors. So 30% of banking is with private sector, 70% with government banks. I believe over the next 3 years, there is a huge market to be gained by the private sector banks, and they will continue their growth. So I am saying typical sectors and industry companies that one talks about, that I believe there are plays possible.
Let's understand the impact of lower commodity prices. On paper, lower commodity prices, that's great news for Indian economy. But in the short term, in the medium term, there are also headwinds which automatically will come given the way how commodity prices have come down. There is a problem for banks which have exposure to the steel sector. It's a problem for the aggregate Sensex earnings because commodity companies will no longer be contributing. So rather than having a one-sided approach on decline in crude and decline in commodity prices is great news, should we be more realistic here?
But that the market has already corrected, whether the commodity metals are concerned or anything related to those prices that have the market has given the negative impact on those commodity stocks, right? The market has given a negative impact. The banking index has corrected almost 20% today. So market has corrected itself wherever it had to correct. But a lot of upside that can come out of the decrease in commodity prices in various sectors, we'll see that upside also coming in the earnings over the next 2 years. And ultimately, we are believers of cycles. One of our fund managers has gone into commodity stocks also. We have got various kinds of funds and various different fund managers with the different thought processes. So if one of my fund managers who plays contra has gone into and has taken metal stocks also in that, because he is a firm believer that cycles will turn back and over the next 2 to 3 years you will again see some of the commodities prices coming up. So he has taken his bets on that. So there are various ways. One is the user industry benefit will come over a period of time. And second is the commodity stocks itself have got corrected so much. There is one oil company where you can actually, there is more cash in the company than what the share price suggests. The cash per share is more than the market price of the company. So that's the kind of opportunities that are available. So one has to bottom up stock picking in each of the sectors will help to do.
Nimesh, it's interesting that in this current turmoil stroke market correction, large cap stocks have corrected more than mid cap stocks. Why is that happening? Historically, if I look at market corrections, it starts with large cap and then mid caps, they fall and they fall much more than large cap stocks. Currently, it's the other way around.
If you see since October 2013, where a lot of mid caps were available at a PE of 4 and 5, today the situation is such that the mid caps are much highly priced than large caps in terms of PE ratios. Now, when we see who's buying large cap and who's buying mid caps, to a certain extent, large caps have been corrected because the foreigners have sold over the last 1.5 months. So because of that, the large caps have corrected faster. To a certain extent, we at mutual funds also have helped in the mid caps not falling as much, because if there are inflows in mutual funds or the local markets are giving inflows, and if we are more investors of mid caps as an industry, I'm not talking about me as a company, we have taken a overweight position on large caps, and as much as possible we are into large caps. But I believe that a lot of flows have come into mid caps, where it has gone into mid cap stocks. So there is a buying support available for mid caps, where there is a selling pressure on large caps. That is why large caps have corrected more than mid caps. That's why my investment thesis is invest in large caps today and not in mid caps, because I feel there is more risk in mid caps today than large caps.
So are you making a case that mid cap as a category could correct because it hasn't corrected at all?
Mid caps are correcting and they will correct going forward. When the flows in the mutual funds get slightly subdued, then mid caps can also correct to a certain extent. I would put my investments into large caps today and not in mid caps, because I see more risk in mid caps today. And some quality mid caps are available at ridiculously high prices. We to a certain extent don't understand that when a company where you get a consumer company which is available at 75 and 70 PE, in fact we have gone wrong on that that a lot of companies which were at 40 PE are now at 75 PE, and despite the current fall, that company remains, and the company is not showing, showing a growth of 25-30%. A good company, so quality mid caps are valued very high, and they have not fallen as much as large caps have fallen. So I would be very cautious on those counters.
So
quality mid caps.
So my next
they are getting buying support with inflows coming into mutual funds.
Okay, my next question is, let's talk about financials. Financials are supposed to be the best proxy to any economic recovery. That's been the underlying thesis, and that explains the that why financial is a crowded trade. What explains such a sharp crack in financials? And it's been pretty much across the board. I'm not even talking about PSU banks, private banks, quality NBFC. Every major financial stock is simply getting, is cracking.
Yeah, with whatever is the pressure on the economy, with the commodity prices come down to a certain extent, the non-performing, there is a risk on the non-performing loans, and that has been played out. That is one part. Second part is, if there are sell-offs, the foreigners are big time investors, almost 30% of their portfolio is in financials. So when they come out to sell and the local institutions are buying more of mid caps, there is no buying support available over there. That is why we have seen this correction of more than 15%.
Are financials looking cheap, or private banks, which could be a great client to own, is still expensive? Because the difference between PSU banks and private banks now, I guess, is at a historic high.
Yeah, I would still go for a business which is acquiring market share, and I will today invest my I would be an investor of private sector banks more than in public sector banks, because I believe they have got a robust business model which can take on retail big time. If the retail business of this private sector banks will increase, I think there are NBFCs, there are private sector banks which I will invest in.
The economic recovery has got delayed. The economic momentum has not picked up, it has not accelerated at all. So is it time to revisit cyclicals, industrials, because that had become a consensus trade in early Jan and late Feb. Revisit cyclicals, revisit economy related stocks, because when the economy will come back, these groups and these sectors would benefit. Is it time to rethink that basic asset allocation?
There was a huge expectation in the month of May 2014 after the elections, where it was believed that the government is going to come and do some fast measures, and which is required by the economy. But by July, August, it was very clear that everything is going to happen on a systematic basis, on a policy basis, and no fast decisions are being taken. So in that scenario, I think the market has understood that things are going to happen slowly. Even if the government has got, so there are triggers like the land bill which has gone. The market is waiting for the trigger of GST. So changes are going to, now I think the entire market has realized that changes in this country will be very slow and steady. They are not going to be, it is not possible with the current political structure that we have in place, where any fast changes are not possible, which are desperately required by the economy. So I think market has more or less discounted that it is going to be a slow change. While the revival will come, it will take time, that all of us realize, I guess.
Now, Nimesh, historically, we've seen that every time markets, when they correct sharply, the market behavior tends to get more and more polarized. Everyone will now hunt for quality stocks, or perhaps take shelter in IT and pharma stocks. So in the interim, do you think the outperformance in IT and pharma stocks is here, and the premium at which some of the quality stocks have trended in the past, will that premium only increase and explode? Because there are only few companies where you can see earnings visibility.
That's where we believe that to a certain extent these sectors are slightly highly priced, especially pharma, where we believe it is there might be some bottom up ideas, but overall we feel that sector wherever, and we have tried to stay away from that, because from here a company which is already sitting on a 40 or a 50 PE, we as a fund house are not buyers into those stocks. So we have always stayed out from that, and we have paid a price in the last 1 year for staying out of that. But we believe over a period of time, we are convinced that you have to make money by buying relatively stocks which are cheaper than their intrinsic value. We are value investors and will remain that way. So some of the sectors that you mentioned, the pharma sector, I don't think we are present to that extent, and I don't think going forward they can give that kind of returns, especially some specific stock. I'll not talk about sectors, but companies with very high PE ratios, we are uncomfortable. Though market is going and buying those stocks, we are uncomfortable. It is not sustainable.
So where are you picking your spots? You don't like pharma, you don't like consumer names. For the longest time, you've not bought any expensive FMCG stock as well. So where are you picking your spots where valuations are attractive and growth visibility is also easy to predict?
One is the area that we have picked up is auto. Second, auto we believe is it's fairly priced for the growth that we expect over the next 3 years in auto segment, especially four-wheelers. Private sector banks, I already mentioned why we believe that they are gaining market share, and over a period of time their retail franchise is too strong and will take us and they will be able to do well in a country like India. Third place is the utilities that you would have seen even since you study our portfolio very well. We look at interest rate drop as a theme. If interest rates are going to reduce in a company, companies with a reasonable, there are some utilities in this country which are available at a very cheap level. So I feel utilities which are nothing but a bond, because of 15% CAGR is more or less ensured in those utility companies. Say a utility which is there in power distribution, right? You know what it is going to earn over the next 2-3 years. Still it is available cheap. When the interest rates go down, they will benefit out of it. So I feel that's a good play. And another play that we have played in the last, since the last time, one of the technology, after the last quarter results of last year, we had given a call on technology, and because we believed in a strong dollar, and we are still sticking to our call. It has given good returns. It has given almost in the last 3-4 months, technology has given almost 12 to 13% return, and we are still sticking to that call of ours on technology.
So
I said technology, banking, auto, utilities.
Okay, you've just mentioned the sector, so I don't need to summarize. But if I have to really summarize today's market interaction, and this is just for the benefit of some of your unit holders and our viewers, according to you, this is a good time to put money to work. Rather than running from this turmoil, one should be participating and one should be allocating capital with the assumption that in next 2 to 3 years, equity markets will stabilize, earnings will pick up, and the return delivery could be substantially higher.
Right, that's exactly, because there are bottom-up companies where I believe that there is more capacity that the company capacity utilization can be increased. With that, the operating leverage will pick up, and over the next 3 years, their results will be better. And they will be able to, I think there are lots of companies where profits can go up as high as 50% in the next 3 years. And that's the companies that we are paid to select for you.
And we always get a big call from you. 2013, your big call was allocate disproportionate amount of money into mid and small cap stocks. Beginning of the year, when the markets were going all rah-rah, you said, look, watch your back, revisit a volatility fund, which has done exceptionally well. But now, for rest of the year and for next 6 months or so, your call is that one should not chase mid-cap stocks, one should invest in large-cap stocks.
Large caps, yeah. I completely agree. At 25,000, large caps looks great.
Nimesh, really appreciate your time, and thank you very much for this interaction.
Thank you.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.